Value Investing, From Graham to Buffett and Beyond, by Bruce C. N. Greenwald, Judd Kahn, Paul D. Sonkin, and Michael Van Biema. Introduction. Imagine it's 1973. The country is in a funk. The stock market is collapsing. And one of the most respected newspapers in America, the Washington Post, is on sale for a ridiculously low price. The entire company, with its legendary newspaper, its television stations, and all its valuable real estate, had a market price of just $80 million. Now, one man looked at the situation, a man who would later become the most famous investor in the world. And he knew something that almost nobody else seemed to see. He knew that if you were to sell off the company piece by piece, you could easily get $400 million. Maybe even $500. The market was offering to sell him $1 for just 20 cents. While everyone else was panicking, running for the exits, this man, Warren Buffett, calmly started buying. He wasn't guessing. He wasn't gambling. He was operating on a secret, a powerful, timeless principle that has created more wealth than perhaps any other single idea in financial history. What was that secret? It's the very heart of the book we're going to explore today, Value Investing, From Graham to Buffett and Beyond. This isn't just another book about picking stocks. This is the modern playbook for a discipline created by the legendary Benjamin Graham, the man who taught Warren Buffett everything he knew. It's a way of thinking that turns the chaos of the stock market into a field of opportunity. And my promise to you is this: by the end of our time together, you will understand the three core pillars of this powerful philosophy. You'll learn to see the market not as a scary, unpredictable monster, but as a moody business partner who, on his bad days, offers you incredible bargains. You will learn the difference between price and value, the single most important distinction in all of investing. This isn't just about money. It's about developing a mindset of patience, discipline, and independent thought that will serve you in every area of your life. So, let's begin. Book summary. To really understand value investing, you have to meet a character. A very peculiar man. Benjamin Graham, the father of this whole philosophy, gave him a name. He called him Mr. Market. Imagine Mr. Market is your business partner. Every single day, without fail, he shows up at your door and offers to either buy your shares in a business or sell you his. The thing about Mr. Market, though, is that he's a manic depressive. Some days, he's euphoric. He sees nothing but a golden future, and he'll offer you outrageously high prices for your shares. On other days, he's inconsolably pessimistic. He's convinced everything is heading for disaster, and he'll offer to sell you his shares for pennies on the dollar. He doesn't mind if you ignore him. He'll be back tomorrow with a brand new price. Now, most people get their cues from Mr. Market. When he's euphoric, they get excited and buy. When he's terrified, they panic and sell. They let his emotions dictate their actions. But the value investor does the exact opposite. The value investor understands that Mr. Market's prices are just his mood swings. They have very little to do with the actual, underlying value of the business. The value investor's job is simple: to take advantage of Mr. Market, not to be guided by him. You happily sell to him when he's giddy, and you gratefully buy from him when he's miserable. This is the foundational idea of value investing. It rests on a revolutionary concept that Graham introduced to a world that was treating the stock market like a casino. He said a stock is not a lottery ticket. It's not a blip on a screen. A stock is a small piece of ownership in a real, living, breathing business. And because it's a business, it has an intrinsic value, a true underlying worth that is separate from its daily stock price. The whole game, the entire discipline, is about figuring out that intrinsic value and then waiting, with immense patience, for Mr. Market to offer you a price that is significantly below it. That gap, the difference between the intrinsic value and the price you pay, Graham called it the most important phrase in investing, the margin of safety. It's your protection against bad luck, errors in judgment, and the wild mood swings of Mr. Market. It's what makes investing safe and profitable. Buying $1 for 95 cents is risky. But buying $1 for 50 cents? That's where the magic happens. So, if the whole secret is to calculate intrinsic value and buy with a margin of safety, two questions immediately come to mind. First, where on earth do you find these bargains? And second, how in the world do you calculate this intrinsic value? Let's start with the first question. Where do you find these hidden gems? The book puts it beautifully. You have to fish where the fish are. You don't go looking for bargains where everyone else is looking. You don't hunt for treasures in the middle of a crowded auction. Value is almost always found in the places that other people are ignoring, avoiding, or fleeing from. Why do these opportunities exist? The book explains that it's because of powerful, predictable biases that affect almost every investor. There are institutional biases. Many huge investment funds, the ones managing billions of dollars, have rules that prevent them from buying certain kinds of stocks. Maybe a company is too small. A $5 billion fund can't be bothered with a $50 million company. It's just not worth the paperwork. So, small companies are often ignored and, as a result, undervalued. Then there are what you might call career preservation biases. Most professional money managers are employees. And the safest way to keep your job is not to be a hero, but to look like everyone else. Nobody ever gets fired for buying IBM and having it go down. But if you buy some weird, unknown, ugly duckling stock and it goes down, everyone remembers you're the one who picked that dog. So, managers tend to huddle together, buying the same popular, glamorous stocks. This herd mentality drives the prices of winner stocks to absurd heights and pushes the prices of loser stocks even lower, creating opportunities for those willing to stand apart. And finally, there are the psychological biases that live inside all of us. We tend to get overly excited by recent good news and overly depressed by recent bad news. We extrapolate the present into the future, assuming a company that's growing fast will grow fast forever, and a company in a slump will stay there. Value investors know that one of the most powerful forces in business, as in life, is reversion to the mean. High flyers eventually come back to earth, and the downtrodden often find a way to get back on their feet. Horace wrote it 2,000 years ago, "Many shall be restored that now are fallen, and many shall fall that now are in honor." That's the value investor's creed. So, you hunt in the unpopular places, tiny companies, boring industries, companies that have just reported bad news, spin-offs from larger corporations that big funds dump without even looking at them, and even companies in bankruptcy. You're looking for gems in the trash heap. But finding a cheap stock is only the beginning. The real work is figuring out if it's a true bargain or just trash. And that brings us to the second, all-important question. How do you calculate intrinsic value? Most of Wall Street tries to answer this question by predicting the future. They use a method called discounted cash flow analysis, where they try to forecast a company's profits for the next 10, 20 years, and then crunch them into a single number. The authors of Value Investing argue that this is a fool's game. It's like trying to navigate a ship by staring at a star that might not even exist. The further out you try to predict, the more your beautiful, precise calculations become pure fantasy. A tiny change in your assumption about the growth rate 10 years from now can cause a massive change in your valuation today. The Graham and Dodd approach, as updated in this book, is far more grounded. It's a three-step process, moving from the most certain and reliable information to the least. Think of it as building a house. You start with a solid foundation, then you build the structure, and only at the very end do you think about adding a fancy, speculative rooftop deck. The first step, the foundation, is asset value. Before you worry about profits or growth, you ask a simple question: what is the company's stuff worth? You start with the balance sheet and you go through it, line by line. Cash is cash. That's easy. But what about the factories, the land, the equipment? Here, you have to make a critical judgment. Is this business in a dying industry? If so, then its assets are only worth what you can get by selling them off in a liquidation, basically, scrap value. But if the industry is viable, then the assets should be valued at their reproduction cost. This is a powerful idea. It's not what the company originally paid for its factory. It's what would it cost a competitor, today, to build a similar factory from scratch. This gives you a hard, tangible floor for the company's value. In a competitive market, a company shouldn't trade for long below the cost of reproducing its assets. If it did, no one would ever build a new factory. They'd just buy the existing company on the cheap. Benjamin Graham loved this approach so much he took it to an extreme. He looked for companies he called net-nets, companies trading for less than their current assets like cash and inventory minus all their liabilities. In effect, you were getting the business, the factories, the brand, everything, for free. Those are almost impossible to find today, but the principle remains: start with what you can touch. The second step, the main structure of the house, is earnings power value, or EPV. This is where we start to think about profits, but with a crucial discipline. We are not going to guess about the future. We are going to calculate the value of the company based on its current, sustainable earnings, assuming zero growth. The formula is simple: EPV equals the company's adjusted earnings divided by its cost of capital. Let me break that down. Adjusted earnings means you take the reported earnings and you clean them up. You smooth out the bumps from business cycles. You account for any accounting gimmicks. You're trying to find a realistic number for the cash the business can generate in a normal year, year after year. Then you divide that by the cost of capital, which is just the return investors demand for putting their money into a business like this. If a business generates $1 million in sustainable earnings, and investors demand a 10% return, its earnings power value is $10 million. It's that simple. Now, here is where the true genius of this framework reveals itself. You compare the two values you've just calculated, the asset value and the earnings power value. There are three possibilities. Case 1. The earnings power value is much lower than the asset value. This is a big red flag. It means the company has all these valuable assets, but the management is failing to generate a decent profit from them. The business is being mismanaged. For some aggressive investors, this is an opportunity to buy the company and force a change. But for most, it's a sign of trouble. Case 2. The asset value and the earnings power value are roughly equal. This is what you'd expect for most companies in a competitive industry. It tells you that the company is earning a normal, fair return on its assets. It's a solid business, but not a special one. And that brings us to case 3, the one that gets every value investor's heart racing. The earnings power value is significantly higher than the asset value. What does this mean? It means the company possesses a secret weapon. It has something that allows it to earn abnormally high profits on its tangible assets. That special something is what Warren Buffett famously calls a franchise or an economic moat. This is a durable competitive advantage that protects the business from competition, like a deep moat filled with crocodiles protects a castle. Without a moat, competitors will see your high profits and swarm in, building their own factories, copying your products, and driving down prices until all the excess profit is gone. We saw this with the book's example of a hypothetical toaster company. As soon as it started making great money, competitors rushed in, and soon enough, profits returned to normal. Even a powerful brand like Mercedes-Benz couldn't sustain high profits because competitors like BMW and Lexus could enter the luxury car market and compete on equal terms. A true franchise, a true moat, is rare. The book identifies only a few sources. First, a company might have a unique cost advantage. Maybe it has a patent or a secret process that lets it make things far cheaper than anyone else. Second, and more common, is customer captivity. This happens in a few ways. It can be from habit. Think about how hard it would be to get a lifelong Coca-Cola drinker to switch to a new brand. It can be from high switching costs. Once your whole company is trained on Microsoft Windows, the cost and pain of switching to a different operating system are enormous. Or it can be from high search costs. Most people don't shop around for a new home insurance provider every year because it's a complicated and annoying process. And the most powerful moat of all is the combination of customer preference with economies of scale. When a company dominates a market, like Intel does with microprocessors, it can spend more on research and development than all its competitors combined, yet its rand cost per chip is lower because it sells so many more of them. This creates a virtuous cycle that is almost impossible for competitors to break. A company with a deep, wide moat is an incredible business. The difference between its high earnings power value and its lower asset value is the value of this franchise. And this brings us to the third and final step of valuation, the speculative rooftop deck, the value of growth. This is the most dangerous part of investing, because it's where dreams and fantasies live. Wall Street loves growth. But the hard truth, the book argues, is that most growth creates zero value for shareholders. How can that be? Because growth isn't free. To sell more, you usually need more. More factories, more inventory, more employees. All of that requires more capital, more investment. For a normal company, one without a moat, the return it earns on that new investment is just enough to pay the cost of the capital required. All the new profits are eaten up paying for the growth itself. The existing owners are left with nothing. The only growth that creates value for shareholders is growth within the franchise. It's when a company with a strong moat can reinvest its profits at a high rate of return, a return that is greater than its cost of capital. Coca-Cola expanding into a new country, or Microsoft selling a new version of Office to its captive user base, that is valuable growth. But when that same company tries to expand into a business where it has no competitive advantage, it's just as likely to destroy value as create it. So the complete Graham and Dodd valuation framework is this. First, build your foundation on the rock-solid value of the company's assets. That's your first and most reliable estimate of intrinsic value. Second, calculate the earnings power value, the value of the current business as a sustainable, no-growth enterprise. If this is higher than the asset value, you've likely found a company with a franchise. The difference between the two is the value of that franchise. And only then, if and only if you've identified a durable franchise, do you dare to place a value on its future growth. For the most conservative value investors, the best strategy is to pay only for the assets or the current earnings power, and get the growth for free. That provides the ultimate margin of safety. This three-part approach forces discipline. It separates what is known and reliable, the value of assets today, from what is speculative, the value of growth tomorrow. It grounds you in reality. The rest of the book beautifully illustrates these principles through the stories of 8 master investors, each with their own unique style, but all united by this core philosophy. You have Walter Schloss, a man who worked for Ben Graham himself. His approach is the purest form of the discipline: keep it simple, and keep it cheap. He and his son Edwin run a portfolio of 100 or more stocks, each bought at a discount to its asset value. They don't talk to management, they just read the financial statements. Their philosophy is that if you buy a basket of cheap stocks, you don't need to know which one will work out. The ones that do will more than make up for the ones that don't. Then you have someone like Glenn Greenberg, who takes the exact opposite approach to portfolio construction. He follows Mark Twain's advice: put all your eggs in one basket and watch that basket. His firm, Chieftain Capital, typically owns only 8 to 10 stocks. But before they buy, they investigate a company so thoroughly that they know it inside and out. They are looking for those rare, wonderful businesses with deep moats that they can buy at a reasonable price and hold for years. They call these opportunities 2-inch putts, investments with a high probability of success and very little risk. You meet Mario Gabelli, who refined the idea of intrinsic value into what he calls private market value, or PMV. He asks, what would a smart, informed industrialist, someone who knows the industry inside and out, pay to buy this entire company? He then looks for a catalyst, an event like a merger, a restructuring, or a change in regulation that will unlock that value and close the gap between the public stock price and the private market value. And of course, there's Warren Buffett, who represents the evolution of the discipline. Influenced by his partner Charlie Munger, Buffett moved away from Graham's cigar butt approach, buying terrible businesses just because they were dirt cheap, to his famous mantra of buying wonderful companies at a fair price rather than fair companies at a wonderful price. For Buffett, the quality of the business and its long-term franchise value became paramount. Investing, for him, is simply the act of allocating capital to the best possible businesses. Each of these masters, Seth Klarman, with his obsessive focus on risk and finding motivated sellers, Michael Price, the activist who buys large stakes in companies and forces management to enhance shareholder value, demonstrates a different facet of the same gem. The core idea is always the same. Know what a business is worth. Pay a lot less for it. And have the discipline and patience to wait for the world to recognize its value. It's a philosophy that is simple, but not easy. It requires a temperament that is immune to the madness of crowds, a deep-seated curiosity about how businesses work, and an unwavering belief that in the long run, value will always prevail. Commentary. So, what do we take away from all of this? When you first encounter the ideas in value investing, they can feel a little old-fashioned. In a world obsessed with speed, technology, and explosive growth, a philosophy built on patience, tangible assets, and skepticism about the future can seem out of place. But I think that's precisely why it's more important today than ever before. The single most powerful lesson in this book isn't a formula for calculating P/E ratios. It's about temperament. It's a way of being in the world. It's about the profound strength that comes from thinking for yourself. We live in an age of noise. Every day, we're bombarded with opinions, hot tips, and urgent calls to action. The story of Mr. Market is more than an analogy for the stock market, it's a metaphor for modern life. There's always a crowd telling you what to think, what to want, and what to fear. Value investing is, at its core, a discipline of intellectual independence. It's the courage to stand apart from the crowd, to trust your own analysis, and to act on your own judgment, even when, especially when, everyone else thinks you're crazy. The second thing that strikes me is how this book demystifies the world of finance. It teaches you that a company isn't some abstract entity represented by a ticker symbol. It's a collection of assets and a stream of earnings. By breaking valuation down into those three simple parts, assets, earnings power, and growth, it gives you a tangible, logical framework. It turns something that feels impossibly complex into a puzzle that can be solved. You start to see businesses everywhere, not just on the stock exchange. You look at your local coffee shop, the software on your computer, the car you drive, and you start to ask the right questions. What are its assets? What is its sustainable earning power? Does it have a moat? This way of thinking is a superpower. It allows you to see the economic reality underneath the surface of things. So, how can you start applying this wisdom right now, even if you're not ready to invest a single dollar? First, start by cultivating your own circle of competence, as Warren Buffett calls it. Don't try to be an expert on everything. Pick one industry that genuinely fascinates you. It could be video games, or fashion, or renewable energy. Read its trade magazines. Learn its language. Understand who the major players are and what their competitive advantages are. Your goal isn't to pick stocks, it's to become truly knowledgeable about one small corner of the business world. This is how you build a foundation for sound judgment. Second, practice the mindset. The next time you hear about a company whose stock has crashed, resist the urge to think, "That's a disaster." Instead, ask the value investor's question: is this an opportunity? Pull up its financial statements. Look at its balance sheet. How much cash does it have? What's its book value? Is there still a real, tangible business underneath all the bad news? You don't have to buy anything. You're just training your mind to see value where others only see fear. And finally, cultivate patience. Value investing is not a get-rich-quick scheme. It's a get-rich-slowly, and stay-rich-surely scheme. It's about playing the long game. In a world that rewards instant gratification, the ability to wait for the right pitch is an incredible advantage. That was a summary of value investing, from Graham to Buffett and beyond. We've explored the core principles today, but I have to be honest with you. A summary is like looking at a map of a beautiful country. It can show you the major cities and the highest mountains, but it can never replace the experience of actually walking the trails, meeting the people, and discovering the hidden valleys for yourself. The real magic of a book like this happens in the quiet moments of reading, when a particular story or a simple phrase connects with you in a way you didn't expect. This summary is meant to be your map, to help you decide if this journey is one you want to take. If anything we've talked about has sparked your curiosity, I urge you to grab a copy. Reading it isn't just about learning, it's an experience that can fundamentally change the way you think about business, money, and maybe even the world. Also, if you found this journey valuable, it would mean the world to me if you'd hit that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book. Let's keep learning and growing together.